Hi, this is Roger Michalski, publisher of Eagle Financial Publications here in Washington, D.C. I'm here with Brian Perry, the editor of the Cash Machine newsletter. Brian is an expert on income investing. And today we're talking about covered calls, selling covered calls, and the option premiums you can get from those, and how you can really substantially increase your income stream. So tell me, how risky is this?
Well, when people mention the word options, Roger, they typically think there's a lot of risk associated with that. But like in any market, there's two sides to every trade. If you're buying puts and calls, then you're taking substantial risk because it's a time-wasting asset that most people are somewhat familiar with, and we'll get into that in terms of how the mechanics work. But if you're selling calls against an underlying position, then that's basically a risk-free trade, so to speak. What you're doing is basically giving someone else the right to buy your stock away from you at a higher price than where it's currently trading. And that right is worth money. And so that's what is an option contract, and you're selling that right out to someone else. Let's say you own 100 shares of Starbucks, and it's trading at 55, and you're willing to sell an option contract that allows them to buy it away at $60. That money you bring into your account that very moment, and it's in a form of cash. So the real risk is if Starbucks goes to 65 and you've agreed to sell it at 60. So you may lose some upside, but you brought in some call premium. There's always risks associated with stocks. If you're long Starbucks and you get into a market correction, then there's always downside risk, and that's where people should use some form of a sell discipline strategy that's associated with that. Bringing in call premium actually reduces that downside risk because you're bringing in some extra cash that's going to also cushion your cost basis. So from the standpoint of risk, it actually eliminates or reduces lots of risk from the standpoint of being long growth stocks, and at the same time, the risk is kind of it's a nice risk to have, so to speak, because if you get called away at a higher price, you may have left some money on the table, but you're still going to the bank with a capital gain.
So nothing's risk-free. So is that the downside right there?
It really is. That's the downside because if assuming that the stock does fall below 50, it closes below the strike price, that option is going to be worthless. But if you sold it for $100, $200, or $300 per contract, that money's 100% yours. So there's always risk again of a market pullback or a stock pulling back more so than the cost basis. But that's something that every investor has to determine whether or not they want to hold their stocks through certain volatile times. Selling covered calls, quite frankly, it brings in the kind of income that people are looking for, and at the same time does take an element of risk out of being long that security, because if you bring in, call it $3 worth of option premium, and your cost is $55 on a stock, that theoretically means that your break-even point is 52. So you can allow the stock to move roughly 3 points below before that option contract premium that you brought in becomes where the total position is in a negative position. So there's some downside cushion to bringing in option premium, and at the same time you generate income, and hopefully the stock continues to maintain in your account and not go ballistic to the upside where you leave a lot of money on the table. But that's a nice problem to have, as we say in the business.
Yeah, absolutely. A low risk way to bring in more income.
Exactly.
Who doesn't want that?
Right.
I'm sure people are wondering how much time this takes, and is it easy or is it not? And it is easy. It doesn't take a lot of time, and we're going to talk about that in the next video. So this is Roger Michalski along with Brian Perry. Thank you for watching the video, and we'll see you on the next one.